Well, that's odd.
It's every time we do the intro, it's just a little different. It's that keeps it fresh.
Every single time. It's a little dark in here today, but I'm going to roll with it because this is actually we have some closings or we have a closing today that and some other minor details. So we're actually pre-recording this.
Yep.
It is still Friday, but we're started actually an hour early, a little bit over an hour early.
Yeah, to get it ready, but I just have to make sure, and God knows that we need to close that property today.
Oh
so.
yeah, it's got to be gone. So no mistakes today. Today of all the other days that things could go wrong, this is not the day for that to happen. So
Not today. And just to preface this, like Ken's a little under the weather today, but I am feeling much better than yesterday. So, but if I mute myself or go into a coughing fit, like pardon me in advance, just so you know.
yeah, I actually I felt terrible for even calling you yesterday. You picked up the phone. I was like, oh my god, dude.
Oh, it's all good. Gotta get the deal closed, brother. Unless I'm in the hospital, like we're getting the deal closed. You know what I mean? So
Yeah.
it's the way life rolls for the real estate investor.
That's right. All right. Well, I'm going to try and keep your. Well, I tend to take over these damn things anyway, but I'll try and keep it so you're not so having to be so verbal this time. But
no worries, appreciate that.
But anyway, welcome to the podcast, guys and gals. Today, we thought we actually had a comment. I think last week about mortgage wraps, and so I thought we'd just cover that today. Probably, I mean, there's just not enough time. We have an hour, to be on this podcast, but. And an hour is nowhere near long enough for us to go through every single detail about this. But for those of you who, I don't know, maybe have been curious about what a mortgage, maybe just you're curious about what a mortgage wrap is and you just don't know what it is. But also, there are a couple of different types of mortgage wraps that some people might not be aware of. So we're going to talk about the two ways that we actually do them, and some of the benefits and the pros and cons, as they say, of these different ways of conveying title to a buyer. So, Ken, before we get started here, do you have anything you want to throw in here, or are you good?
Yeah, sorry. Pause for the coughing cause there. Just one thing. Like when we talk about this stuff today, like we're not attorneys. We're not real estate attorneys. We're not giving legal advice. We're just portraying to you actual experience that we have doing these deals. So just want to make that little disclaimer. And mortgage wraps are not illegal, by the way. They're only illegal if you screw it up.
Even then, it might not be unless it's just outright fraud.
Right. It might not conform totally with whatever your state's laws are if you mess something up. But you're good. They're all legal. So with that said, Mr. Kaufman, I'll kick off the first question. Okay. So just let's define. And I know we've talked about some of this stuff in other podcasts too, but let's just define what is a mortgage wrap and go from there.
All right. So a mortgage wrap, what is it? What we have is I like to look at it through the lens of our business model and how we disposition properties. And essentially what we do is we buy properties, generally speaking, we buy them subject to. So we have an underlying mortgage. A mortgage wrap is going to be nothing more than a mechanism or an instrument that allows you to convey title via this would be seller financing. Allows you to convey title, whether that be equitable title or legal title, and we'll get into those here in just a minute, to your buyer Why that and when you do that, you're actually just going to wrap. It's in the name. You're going to wrap that underlying mortgage into that into the conveyance that you give to your buyer. Meaning, your buyer is going to pay you. You are going to pay your underlying mortgage. It's really that simple. It's not that complicated. Um, but yeah, I mean, it's. I think probably the most complicated is people are going to ask, well, how do you do that? And we're definitely going to talk about that. So
So
why? Go ahead. Go ahead.
so sorry. So just real quick, just let's make sure we have a distinction too.
Mhm.
Like so wrap is you're going over the top of an existing mortgage right there. So it's subject to. You're going over the top of it too.
Mhm.
And when people say subject to, you're not necessarily creating another loan to wrap around it. You might just be taking over, assuming the payments on the other loan,
Mhm.
right? So I think some people have a little confusion about that. So just wanted to.
Yeah, yeah, yeah. Well, this is most commonly going to be used in if we're talking about us being the sellers. It's most commonly going to be used for it's perfect for a subject to deal. It's really really. I mean, it's just the best example of what a mortgage wrap could be if you're buying property subject to and you want to hold on to them long term. And so that's my favorite model. That's what I love to do. As many of you probably know by now, I do not like to be a landlord. I'd love to be a quote note lord.
Mhm.
All right. So so where do we want to go here? What questions do we got?
We just well, let's just highlight since we're here, like what is a wrap mortgage, and why. Just let's hit again, like why do we love that disposition strategy so much? It's because it always goes back to the trifecta, right? You
Yeah.
you get paid, so we're gonna sell it on seller financing. We're gonna talk about the two options here in a second, but sell it on seller financing. So you get a down payment, right? We're the sellers, so we get a buyer in, so we get a down payment from the buyers. You get paid there. You then arbitrage the interest rates between the subject to note that you have and what you're selling it. So now you get monthly cash flow. That's how you can control your monthly cash flow. And then at the end, when you're paid off, you have the spread that you built in there from the price you sold it at to whatever's owed on the mortgage or whatever you bought it at, right? But there's this spread between those two numbers. So you get paid upfront, you get paid every month, you get paid on the backside. It's the trifecta.
Yep. We could almost do a quad factor too, because you do have certain tax advantages that remain in place even if you do sell on seller financing. So uh, if you're really into the tax side of it, just know that there are benefits to doing this that remain in place after you sell the property on seller financing. So something that I was not aware of until probably 2 months ago when you said, well, we still get to take the depreciation on these properties. I was like, no, we don't. And you're like, yeah, we do. And you were right. So, uh, yeah, depreciation is a great benefit. um, so, we,
Perfect segue right into the next one. So the depreciation model that you're talking about there as a tax advantage. So you're talking about a contract for deed, agreement for deed, land contract, one of those. So we've talked about that in the past on other podcasts, but real quick, let's go back through that. So that's one type, right? So we're going to call it a contract for deed here. The contract for deed is one type of wrap.
yeah.
So why use a contract for deed, Mr. Kaufman?
Well, we love contract for deed just for the simple fact that it's a much safer option for us being the sellers. Um, Generally speaking, contract for deed. Well, again, we're not attorneys, but contract for deed it falls under different. It's not actually. It doesn't fall under real estate laws. It falls under a contract law, and what it allows us to do is, uh, or the benefit rather, is that it is much easier for us to take a property back because we're not actually taking a property back. We're just canceling a contract. Uh, if that if that makes sense.
Well, it's more of an eviction process if
Correct.
you have to remove somebody as opposed to foreclosure.
Exactly.
Now,
Exactly.
every state's just as a right. We're not attorneys again, but every state's different, and sometimes when you get to certain thresholds of equity in other words, certain payment levels, the buyer has made like 20% towards the payments, then it might become a foreclosure process, like in our famous next door neighbor here, Illinois, illness next to Missouri. Illinois next to Missouri. So just keep that in mind. But generally speaking, it's more of an eviction process. So,
It is
worst
much
case.
simpler. Yeah, it's usually much simpler and much cheaper to remove what essentially becomes a tenant. They become an unwanted tenant because you're actually uh, well, the states are generally going to look at that individual as a tenant versus an actual buyer. Even though selling with a mortgage wrap does also qualify as an installment sale, and there are tax benefits to that buyer, there are tax benefits to us. Even though that still does qualify as an installment sale, in the eyes of the courts, until you hit that level of equity, until your buyer hits that level of equity, which is generally, like you're saying, 20%, until they hit that level, they're looked at as a tenant in the eyes of the court. So it's much cheaper and much simpler uh, to get them out of the house should they default on the loan. Um, what I really, really love about contract for deed is that I get to retain legal title, and that's what gives me all of this ability to, if I have to involve the courts, I still have legal title to the property. Whereas, if we use another method, which we're going to talk about here in just a minute, if we use the other method, we have to go through foreclosure. We have to, and that can be a long, drawn out process. It can be very, very expensive, and that can be messed up. One mistake in the foreclosure process, and I think could drag on forever. It could turn into. We've actually seen this. We've seen foreclosures in non-judicial states actually turn into judicial proceedings because of mistakes that were made during the foreclosure, and we want to avoid that at all costs if possible. And the way that the right from the get-go, the best way to do that is to not give legal title. Just give equitable title.
What? So just out of curiosity, we're talking about the true wrap here in a second. But why would a buyer want agree to such that because they're not getting ownership interest in the property? It seems like there's never a shortage of people who are more than willing to agree to a contract for deed. But why would, from your perspective, Mr. Goffman, in your experience, why do buyers agree to those terms and conditions?
Well, if I'm really being honest, I just don't give them a choice. Usually, I mean that's usually uh, that's usually the deciding factor. It's like this is what I do. I sell on contract for deed because I like the security of it. Um, Now, I have given legal title, um, and also I have a little hybrid thing that I do. I'll talk about here, but I have given legal title to really well qualified buyers that maybe they're entrepreneurs or they're uh, some folks that are maybe have seasonal income or something like that. But generally speaking, um, and those types of folks, I wouldn't mind giving legal title to. I still don't really care for it. Another thing that another reason you might do that is if you have if the note, if you give them legal title and you create a new note, that note is potentially marketable and you could sell that note if you wanted to. I'm not going to get into the buying and selling of notes, but you could potentially sell that note later on down the road if you needed a cash infusion or something like that. You could sell that note, or you could sell what they call a partial on that note. I'm not interested in that. I'm interested in long term uh, long term cash flow. That's my interest. And so, uh, generally speaking, I'm just going to do a contract for deed. I hope that answers the question. It really doesn't. It's from a buyer's perspective. It is in their interest, their best interest, to get legal title. Um, I just I just don't do that. I just prefer contract for deed because it's the safer option for me. That's really the deciding factor.
Yeah, and honestly, like if we're being honest, not so we're always transparent with people, so they know they're not getting legal title,
Mm-hmm.
right? On an agreement for deed. So like we're okay. Here's what we're retaining. We retain all this tax benefit to the depreciation of the property, blah blah blah. Here's what they're getting on the set, and I don't know. I mean, it doesn't seem like it's that big of a deal to people. Remember, these are people that can't qualify for a normal traditional mortgage anyway, and they're just happy to have some kind of agreement to potentially own a property.
Right, and I talked about that kind of that hybrid thing that I've recently adopted. a lot of times, we'll have a buyer who I'll just give you an example. The last property I sold on seller financing, this individual had an excellent credit score, but their DTI was their debt to income ratio was teetering on the edge, if not slightly over the edge of what Fannie or Freddie would require if they were going to provide insurance on that loan. And so I was really kind of a little bit sketched out. I wasn't really afraid because I mean, with a credit score like what she had, you know, she's earned that credit score, and so I was a little I was a little relieved. However, I still wanted to ensure that I was going to be paid and that I could retain legal title for a certain period of time. So what I did was I said, okay, I'll write you, we'll get the deal done on contract for deed. We'll do it for 12 months. If you make your mortgage payments on time for 12 months, I will convert this to legal title. I will actually give you legal title, and I'll cancel the agreement for deed, write a promissory note and a deed of trust. We're going to talk about how to do that here next, and I will convey title to you, and now you're legal title holder, even though I still have an underlying subject to mortgage that I've taken subject to. So yeah, I don't know if we want to get into that option, to the legal side of things, the legal title side of things.
I think that's coming after the so we'll talk about the next one, a true wrap mortgage.
Yeah.
So a wrap mortgage or an all-inclusive deed of trust in those states. Remember, mortgage is just a term used in those particular states that use mortgages, right? And then we have the all-inclusive deed of trust, which is in the deed of trust states, and it's just a matter of whether you're a judicial or non-judicial state about which one you use, right? But it's really 6 one, half dozen the other, because it's really kind of the same thing.
Yeah.
Right? So.
Yep. Yeah. Before we jump into that, I'm going to talk about just a real quick rundown of the procedure of writing up a contract for deed or selling a property on contract for deed.
Sure.
So, very first thing, obviously, is negotiating price and terms, and we have our excellent subject to calculator out there that can help you do that, and it's probably, well, the results that it spits out are based upon how accurate the input is that you put into it. So go out there, go to the website, sub2empire.com, and up in the menu there's a download link for the subject to calculator. That will help you at least get a baseline for negotiating the price and the terms. The price is going to be based upon, obviously, we like to use active comps in that particular area. And then we'll, generally speaking, since we're offering a property on seller financing, we'll bump that up a little bit just to build in a little more security on the sales price. And then our terms, we touched on a little bit earlier, the terms of that deal. So we're looking at interest rate, amortization rate or amortization schedule, and down payment. Right. So those terms, by the way, can all be built out in the subject to calculator. But those are really what is for sale here. It's how much of a down payment can you collect? When you go to arbitrage those interest rates, what does that interest rate on the sell side look like versus what your underlying loan might have? And so I really like to build in a cushion there of I have a minimum amount of cash flow that I need to make. So I'll start there. I'll adjust that interest rate on the sell side so that I at least get to that minimum. And then if I see that there's wiggle room to increase that, I will go ahead and increase that interest rate to also increase which is also going to increase my cash flow. So negotiating price and terms, this is no different, by the way, for the legal title side, the all-inclusive deed of trust, same exact process. It's just the actual documents that you're going to draft up are going to be way different, way different. So step 2 in the contract for deed wrap is going to be drafting that deed. And we do have a documents package out there. I can't remember. Do we have contract for deed in that? I don't think we do we?
Not in the current,
That's right.
not in the current packages. We don't have. I guess we call these like seller financing disposition documents,
Mm-hmm.
and we not. Those are funny you mentioned that though. Those are on our calendar to put another
Yeah.
doc package out
Yeah, I
there.
couldn't remember if that was actually in the stuff we had now, but by the way, you're going to see different terms for contract for deed. You're going to see agreement for deed, bond for deed. What's another one? There's another one that I heard.
Land contracts.
Land contracts. Yeah, obviously.
Agreement for deed. The bond for deed is pretty much like the only place I've ever heard that's Illinois, but yes, it is used.
Yeah, but those are all interchangeable. It's basically, it's the same thing. You're creating a contract with your buyer, and the terms in that contract, the end game or the benefit in that contract is once they reach or meet the terms of that contract, you're going to convey them a deed to a property. So in some states rather, there is a requirement to either record the contract or record what is called a memorandum of contract.
Yeah.
And essentially what this does is it's going to do, it would do the same thing that a deed of trust would do if you were going to do an all-inclusive trust deed, or if you were going to give them legal title. The recording of the contract or the recording of the memorandum of contract is going to cloud that title. And so it does not, it would prevent, what it's going to do is it's going to do two things. It's going to prevent you from going out and further encumbering any property. Right. Because what's going to happen is if you go out and you try to do a refinance on that property while you have it sold on seller financing, that lender is going to go out and pull title on it. They're going to do a title search, and they're going to see that either that recorded contract or the recorded memorandum of contract. And as long as there's an encumbrance on the property, you're probably not going to be able to do that. So it is a benefit to your buyer for you to record that contract or a memorandum of contract.
Yeah.
And there are states, Illinois being one of them, that it's a requirement when you sell on bond for deed over there, it's bond for deed. When you sell on bond for deed in Illinois, you must record a memorandum of contract. Yep. You have to.
Yeah.
So check your local laws, check the laws of the state that you live in, make sure you're doing it right. In Missouri, we have no such requirement, which is fantastic for us because obviously we can kind of keep things out of the public eye, and it further protects us from, from any kind of due on sale action. It's just another tool in the tool belt that protects us from the due on sale clause. So from there, we are simply going to start collecting payments. And I highly recommend, I think Ken, you do too, to use a note servicing company.
Yeah, for sure.
Here in Missouri, I've used a few of them. I've used some of the big ones like Evergreen. The one that I found in the Midwest, and if you're not from the Midwest, I would just go to their website and see if they actually service your particular state. But Madison Management is the one that I'm going to recommend. They've been super, super great. they've actually found some mistakes in my accounting, uh, or in the collection of payments. They found some mistakes and notified me. They're very proactive. They're awesome. But no matter what, I think you should not be servicing these yourself. Uh, Accounting can become a nightmare. Certainly is a huge nightmare. Um, so I would just hire it. And by the way, you can charge that servicing fee to your buyer, and that's what I do. So any last words on contract for deed? Thank you.
No, I don't think so. I think the only thing I'd say about the management company, and you're right, Madison's a good one because they'll actually serve as agreements for deed.
Hmm.
Not all of them will do agreements for deed.
That's a good point.
They'll do wrap mortgages,
Hmm.
right? Like a true wrap, but they won't do contracts for deed. So you kind of have to make sure that you research that. But Madison does do
Yeah.
both.
And by the way, they also they also are very familiar with trusts. And if you guys have been following us for any length of time, you know we're a huge fan of using trusts to buy real estate. So especially subject to deals, and they do deal with trusts. I have a couple with them right now that are actually have. We actually service our entire apartment building with them too. I mean, they're just fantastic. They're really, really, really good company. But yeah, I just wanted to make sure we understood all that. So let's move into the legal side of things, offering legal title to your buyers.
Yep.
And as you alluded before, of course, we're a deed of trust state, so we call this an all-inclusive deed of trust. You'll see it abbreviated as AITD out there. So if you ever, browsing the Facebook groups and you see AITD, it means all-inclusive deed of trust. But we have the same thing, like you said earlier. We have the same thing with mortgages. An all-inclusive mortgage would accomplish the same thing. There's very, very slight differences between deeds of trust and actual mortgages. Very slight.
Yeah, there's really not much. Yeah.
Yeah. So first, Ken, I'm going to call on you. I hope you're up for it.
Yeah, I'm good.
So
I'm still here.
All right. So let's let them know what does an all-inclusive deed of trust actually accomplish, and what is it? In what situations will we use an all-inclusive deed of trust?
So an all-inclusive deed of trust. So this is the true wrap. So some people call this the true wrap. Mm-hmm. So you have an underlying mortgage, right? And so in our state, again, so there's an underlying deed of trust, right? It's the security instrument. It's that protects the promissory note, the promise to pay on the loan, right? So there's this loan. It's protected with the deed of trust, and now we're going to. So we took it subject to. So we have this deed of trust back here that we're going to pay. That's our obligation when we acquired the property. So now we're going to sell it, and we're going to give another deed of trust and transfer full legal ownership to that end buyer. That's what a deed of trust does. It transfers full legal ownership, and the deed of trust is a security instrument. That means that you can go and take the property back, right? If on default, you can go take the property back. It is a foreclosure action, though. It is a foreclosure action. Okay. Just know that. But I'm going to create this all-inclusive deed of trust. And really, that's just a fancy way of saying that our agreement is subject to this underlying deed of trust that already exists. And by the way, it's not illegal to wrap and wrap again.
Yeah.
And right, like it's not illegal to multiple wrap. But
Yeah.
you just have to make sure that every single layer is referenced and subject to the previous deed of trust that exists.
Yeah, and subservient to.
Yes, it is subordinate to. That
subordinate.
Is
Thank you.
Yeah, you're correct. It is subordinate to. So that means that first deed of trust gets paid off first, right? They get paid off first, and then all these others in the chain get paid off in order.
Yeah.
Okay. So you're just wrapping, and it's a true wrap. So you're taking the one that you have there and you're wrapping a new one over the top of it for your buyer. We are responsible for the one in the middle right? The one underneath, and then the buyer is responsible for making the payment over the top. And of course, that payment will then pay everything underneath because that's how we structured it, right? You just mentioned how do you structure it. So that's how we structured it. And then we have Madison Management or whomever service it and pay everybody, and everybody's happy. Like we did this, and this works, by the way, this works on single family properties. It works on multifamily properties. It works on commercial properties because we did it on a commercial property, right? We bought on seller financing and wrapped the original loan that the seller had to us. So it works.
Yep. Yeah. That one was an interesting one. I was like, well, I don't know. It was just, I think that was the first time I ever done a wrap on a wrap before.
Yes. Yeah, we wrapped the wrap. Yep.
Yeah, it was interesting. Some of the pros of this of a all-inclusive trust deed wrap is that well, the one major benefit for your buyers is they get legal title right away. Like there's no waiting. I talked about that kind of hybrid thing that I had adopted, where I was giving contract for deed for a year and then providing legal title if payments were made on time. This gives legal title straight away, right away. No, as soon as you close, that's it. So it is much more attractive to your buyers who are requesting it and who want full legal title or full ownership. But the cool thing about one of the pros for us is we still retain a security interest in the property, which is the deed of trust. So it's not for me, it's not the best option, but I do still have a security interest. It just means that I will have to foreclose if that buyer defaults. I cannot go to an eviction court and get someone evicted. I have to go through foreclosure court.
Yeah. So, but this is the true note lord model.
Yes.
Like so the agreement for deed, it's still kind of a note lord model, but it's a little bit, as you mentioned, hybrid. It's a little in between, but this is the true note lord model where you're just creating the notes and right. So your cash flow is based on the notes, right? The deed of trust, the underlying promissory note and loan is based on that, not based on, someone paying you straight rent. So,
yeah. Oh, by the way, we know that notes are certainly marketable. Contracts for deed are also marketable. You can also sell contracts for deed like you can a note. It's just your buyer pool is much smaller, and you're probably not going to get as much for a contract for deed as you would a well-written note.
Yeah.
So, but it does have obviously the all-inclusive. I'm going to just call it AITD. I get tired of saying that. But the AITD is a little more legally complex. It isn't so tough. I mean, if for example, if we write an all-inclusive trust deed, we would have an attorney draft that for us initially, but after that, it's pretty much, you could actually buy the template. If you go to deeds.com, you can find a template for an all-inclusive trust deed for literally every state in the country. Deeds.com, it sounds very vanilla and generic, but they are a great service. I've used deeds.com for ton. In fact, I just used them the other day for I had to move a property out of a trust into an LLC, and it was no problem. They're just really, really great. Deeds.com, another huge reference. So let's talk about how to structure the all-inclusive deed of trust or all-inclusive trust deed. It's going to be no different as far as the negotiation goes. Price and terms going to be absolutely no different. You could use our subject to calculator for that as well. I mean, and because your price and terms don't change just because of the different method of conveyance. It's just hammering those details out and then documenting them on paper. So then we're going to have a draft. Step 2, we're going to have a draft of the all-inclusive trust deed. Again, this is a little more detailed. You may want to have an attorney draft this for you. A lot of times, title companies will have these as well. They're going to have very, very cookie cutter documents. I mean, it's not going to be anything mind blowing, but you know, again, I like deeds.com for this. If you're not comfortable with that, definitely seek out an attorney to have them draft that for you. A little bit of difference here in this one is that if you're conveying legal title, you're going to want that title to be clean. And so with this, I actually recommend this for contract for deed as well. But you want to have a title company pull title. Your buyer's going to want this, by the way.
Yeah.
You're going to want to have title company pull title. You want to have a clean title before you convey legal title to your buyers. All right. So this is one that you're going to want to close at a title company for sure.
Yep.
I still recommend you do that with a contract for deed as well, although you're not going to get a title policy using contract for deed like you would with an all-inclusive deed of trust. So nevertheless, though, title company can still pull title. They can still make sure that, if your buyers, if they're kind of sketched out about the chain of title on a property, they may request it. In fact, I have had folks request that they close at a title company, and just have to make it perfectly clear to them that they're not going to get a title policy. But I will provide an abstract of a clear title minus any type of underlying loan that I might have on the property. So, but with a all-inclusive deed of trust, you definitely want to use a title company and they will get a title policy, just like any other normal sale. They will get a title policy. And then last but not least, again, we start collecting payments. Actually, we don't. Our note servicing company starts collecting payments, and you have a separate. Maybe this is something we need to touch on too. Escrow with this. I like to, and Madison will do this for you. I like to, since we already have. If I take let me back up. I'm all over the place. If I take a property subject to, chances are very good that the underlying loan is going to have an escrow account attached to it. And so for my purposes, I don't generally like to, and for accounting reasons, I don't like to maintain two escrow accounts because it just gets convoluted and kind of confusing. And so what I do is I actually collect the payment to my buyer. I'm sorry, the payment to me from my buyer includes my escrow amount. So they don't have to set up another escrow amount. I simply pass through, and I don't make any money on that, but I simply pass through the taxes and insurance as part of their payment. And so I could get a little further in detail with it, but it's just know that all I'm doing is passing through dollar for dollar what is required by the escrow account to collect from me. I'm passing that off to my buyer, and that is just added on to their principal and interest. So they're actually paying the taxes and the insurance. Now, what you could do in that situation, and what most people, a lot of people, what they do is they'll actually have that buyer create a separate escrow account, and they'll fund that account for the next year, which is totally, it's a great idea. Not a bad idea at all to implement that, but just know now you've got two different escrow accounts that you have to kind of keep track of. That's what I don't like the complexity of it. So, and to be honest with you, I haven't had it any other way. Ever since I've been doing the seller finance model, that's exactly what I've been doing, and I haven't had any problems with it. So, but just know that your buyer, they get to take those property taxes that they're paying. They're paying them to you. You're funding an escrow account. Those property taxes are for their benefit. They're paying those taxes, so they get to take the tax benefits of writing off whatever property taxes they've paid on their tax return. So that was a lot, right? That was a lot to swallow. I hope that wasn't too confusing. But with the all-inclusive trust deed, it's a different story. You have to set up a separate escrow account. I mean, it's just if you're going to do legal title, follow the rules that like any other lender would follow, and that would be it would be wise for you to set up an escrow account. Uh, probably a drawback for me. I'm not too crazy about it. It's not that big of a deal. I just like the simplicity of having one underlying escrow account. So you're going to start collecting payments through a loan servicing company. Again, I recommend Madison Management if you're in the Midwest. They may service outside of the Midwest. I don't know, but they do a great job for me here. All right. If you have any questions about any of this stuff, throw it in the chat. I promise you, we definitely read all of those, and we will respond on next week's episode. All right, Ken. What's up next here?
Just let's go back and highlight some of the right risk mitigation. We're big about the risk mitigation, so let's highlight that.
Okay.
So when you take a property subject to, we've talked about this many times. There's the due on sale, and I am awfully dark. Sorry, hold on a second. There we go. See, it lightens up and then it goes back dark. That's just the way it is. It's going to be dark fun Friday today. So the due on sale clause. So if that underlying lender knows that there's going to be a transfer, right? If that title's being transferred, like in a wrap mortgage, if that title's being transferred, they can call the loan due, right? That's the whole point of the due on sale clause. Technically, they could call it due maybe on an agreement for deed, depending on how it's written.
Yeah, even a lease option, they could do it.
But typically, because you're not transferring legal title, the due on sale would not apply an agreement for deed. You just have to structure it properly, right? So that's one advantage of using an agreement for deed, right? It typically will not trigger the due on sale clause, but the wrap mortgage certainly could. So one thing we've heard us say many times, as you mentioned earlier, is that one way, right? So what's the easiest things to do to avoid the due on sale clause? Number one, keep making the payments, stupid.
Yeah.
Number one thing, as long as the underlying loan is being paid, they typically don't care. Okay. Now that doesn't mean you can run roughshod and do crazy shit, right? But typically, if you're making the payments, right, you're going to be okay. Second thing is to take title in a trust. All the lenders across the nation understand people want to put property that they own, whether it's real property or personal property, in a trust for estate planning purposes. That's what a land trust is, right? Land trust is specifically a piece of real estate that goes in there by definition, right? And we've talked many times, some states don't have land trust laws and all that too. That does not mean that you cannot set up a trust. Trusts are legal in all 50 states. Okay. Just don't call it land trust and freak people out. Right. So pro tip there, just don't call it land trust. Just call it revocable trust. A land trust is a revocable trust. Okay.
Yep.
So that's what we would recommend, because all of those people recognize that. We're just doing this for estate planning purposes. Right. Because when you put the property in the trust, you create your layer of privacy. Right. And this is good shameless plug for our land trust package, our basic land trust package that you can grab, and it walks you through exactly how to do that, every document that you need in the trust, et cetera, et cetera. Right. So that's one item. The other item too is, right, the legal risk, as you mentioned, depending on which way you do it, whether it's an agreement for deed or whether it's a true wrap mortgage, right? You have some accounting issues that you need to address in there. And that's another reason why we recommend using a third-party loan servicer, because they take care of all that for you. They send those mortgage interest statements out to everybody. They make sure everybody's paid. They make sure the insurance gets paid, the escrow, the insurance gets paid, the real estate taxes get paid, right? So that's another reason to use them, because it takes some legal responsibility off you and it puts it on them as the loan servicer, right?
All right. Let me see here. I'm looking through a checklist. See.
Yeah.
Let's see here.
Let's see. Did we hit them all?
I think so. Legal risks. Always use a promissory note, deed of trust. Require a down payment that shows commitment. How to protect yourself as the seller. Yeah, that's a good one. first of all, if I'm going to protect myself as a seller, I'm probably going to sell on contract for deed. That's going to be my first
Right.
option. I've
That,
talked about
that
that.
maximizes your protection as the seller, right? For sure.
Yeah, and then a down payment to me, of course, I'd like to collect as much as I possibly can. I think everyone would, but that is not the goal for me. The goal for me is to be able to set up my buyers uh, in a way that they are going to be successful, because obviously that's going to roll downhill. That's going to be, if they're successful and they can afford their payments, and they're not strapped or stressed out every month about how they're going to make their payment. That makes your life easy, because you're getting regular cash flow and you don't have to worry about it. So you definitely want to require a down payment. Um, but that down payment might not be, and also that down payment can be based upon, a lot of times it's based upon, with us, it's how much do we have in the property, and how much do we need to get our money back out of that property. So that's a big factor. But a down payment really, it shows the commitment of your buyer to the deal, right? And it kind of stings a little bit, it hurts a little bit. It If somebody puts a larger down payment in, obviously they're more committed, because if they default, that down payment is gone. One thing I will say about the down payment, remember earlier we talked about eviction, and I'm referring to contract for deed here. If you take a down payment that is so large, let's say it's 15%, and then over the course of uh, the next 5 years, your buyers pay off another 5% of the agreed upon purchase price, you've now hit that 20%. And so if they default anytime after that, generally speaking, you're going to have to go through a foreclosure process. So um, there's a lot of things to think about when you're thinking about down payment, because another thing just popped in my head was, you could essentially, what you want to do with your down payment, in addition to just getting your any funds that you might have in that deal, you getting them back, you might want to think about, well, what if I have to go through a foreclosure? I personally would like the deal to be able to pay for the entire deal. And so if I'm going to collect down payment, I want to keep in mind that down payment, I'm going to set that aside in case I have to end up foreclosing on someone. And so that becomes part of my reserves. And there should be reserves on every single one of your deals that you're buying and holding. There needs to be reserves, period. 6 months. 6 months reserves.
6 months reserves.
Well,
Yeah. At
it
least
used to be
3. Yeah.
Yeah.
Yeah. Preferably 12, actually. But and so the other thing to protect yourself. So we're the sellers. We're getting the end buyer, especially if you want to do straight wraps, right? Wrap the all-inclusive deed of trust, wrap mortgages. If you want to do straight wraps and be a true note lord, then you probably want to make sure that buyer is vetted through an RMLO, residential mortgage loan originator, right? It's the same vetting process that is done for the traditional financing. So that means that if later you want to sell your note, right, you can maximize your process, because the buyer has gone through the same vetting process that typical traditional financing people do. Okay.
Yeah.
Now, well, Jeff, right? People might be thinking there, because this is the first thing I would think is like, well, why wouldn't they just get a traditional loan then? Well, you can massage your own requirements as you want. Just say that, if you vet them in the same way, then your note is as marketable as is the bank's note.
Right.
But you can have your own guidelines.
Yeah. And there's RMLOs have just a much greater understanding of the requirements by note buyers and secondary markets. They have a much better understanding of what is required. And what we're generally told is, let's take a W-2 employee, for example. W-2s, we know that someone with a W-2 automatically is going to take precedence. I mean, their qualifications become less stringent if they have a W-2. However, if the person's self-employed, like the people that generally that we kind of go after, kind of people that we target as buyers, um, they're going to be it's going to be a little more stringent requirements. Maybe not even as stringent, but definitely different. There's going to be, you have to have documentation. There are things that an RMLO can do to facilitate people in those situations where they're self-employed or they're maybe seasonal workers, things that certainly I don't know the ins and outs of. But there are ways that for an RMLO to get someone qualified um, on a note that you could later then market to a note buyer. So using an RMLO in that situation I think it's a must. If you're going to do an all-inclusive deed of trust or a mortgage wrap using all-inclusive deed of trust, definitely involve an RMLO for sure. And RMLO stands for Residential Mortgage Loan Originator. So there's plenty of them out there. Probably look in the Facebook groups for some of the investor-friendly ones.
Yeah.
But yeah, they're vital if you're giving legal title for sure.
So, and we have we kind of went through some real life samples. Remember, we already mentioned that we bought a commercial property on a wrap mortgage, and interestingly enough, right? So the underlying loan that we wrapped on there too wasn't even recorded. Like there was no deed of trust or anything on that too. And so since we were so generous, I actually wrote the deed of trust for them to secure that first. And then we came in there and wrapped over the top of that with our all-inclusive deed of trust, which is, and really it's very similar to deed of trust, as you mentioned. It just has a couple extra clauses in there mentioning the subordination to the previous loan. And so once that's in place, you need to just reference that previous deed of trust that's documented in there. It's recorded on page blah blah blah, and so that's how specific we were in there, right? So it's a little pro tip: match it exactly in there, and then that's how we rolled.
Yeah, there's all kinds of things you can do. I mean, you can. This is why I love the creative side of real estate, because there's just so many things, so many options out there. And we actually, correct me if I'm wrong, that was a 100% profit on that one. On that,
Yeah, and so from what we put down, yeah, from our money in initially till the money back out, it was 100% profit in 6 months. You're correct.
yeah, 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 man. So, I mean, seller financing just opens up. If you have someone who is open to seller financing, whether you're buying, uh, well, if you're buying, I'm always going to choose seller financing when we're selling, but yeah, if you're buying, if you got, it just opens up all kinds of doors. I mean, and quite honestly, you didn't have to do that. You didn't have to offer to record. We could have
Yeah.
taken first position on that.
Well, yeah,
You know,
we had an opportunity to not say some things and just get some things done in our favor, but that's not how
yeah,
we
it's not the right thing to do. Yeah, for
because
sure.
we agreed that, oh yeah, you've got that loan saying, okay, but it's not on title, so let's get it on, let's be official, let's get it on title, because we already agreed that we would do that, so
Mhm.
it was no big deal
Yeah,
to.
because wasn't it? I forgot how it went. The lender, her lender,
Mhm.
had a mortgage. Then he gave her a mortgage, and then we came in and we gave her a mortgage. So
I
yeah, we
think
have
it was a private loan between the two, we wrapped on top of that. Yeah.
yeah.
Yeah, it was an interesting setup, and then
It was.
everybody got paid off 6 months later. It wasn't even that's another thing. See, wasn't even our exit strategy, right? Our
Yeah,
exit strategy was to keep it and have a certain monthly cash flow was actually our agreement, and then it just came along and we're like, yeah, okay,
yeah, yeah. It just so happened that the building. I'll tell real quick the story. The building was it was a pretty large building. It was segmented off. It had office space. It had like a main house
yeah,
with more office space, and it was a daycare. It was a daycare center. Um, then it went vacant. We bought it, and we were marketing for a seller finance buyer, and then all of a sudden we had we had an agent contact us. I can't remember if that was through a sign, wasn't it? I believe it was
It,
through a sign.
it was through the listing. We actually decided to
Oh,
list.
okay. Okay, yeah.
Yeah, we actually tried it to maximize the marketing. It was actually through the listing.
But it just so happened that 5 minutes down the road, there was a daycare that I think the landlord was raising the rents on this daycare, and it was just incredibly expensive. And so we were already zoned for daycare. And so literally this person came from 5 minutes down the road, bought our building, deal we couldn't pass up. It was a great deal. And that's how it went. It was so wild. It's kind of luck of the draw,
Yeah,
that we found somebody else with an identical business, doesn't have to get rezoned.
yeah,
So they can basically go in, make repairs, and they're up and running in, a couple months. It was
yeah.
great.
We were running into some zoning issues because we had a lot of interest from used car dealers that
Oh
wanted
yeah.
to make it a used car dealership, if you remember. And we were getting pushback, even though our zoning was the highest level of commercial zoning actually that allowed for used cars. We were still getting pushback from the county.
Yeah. Yeah, that commercial stuff can take forever. I mean, whether it's just zoning or simply making changes or adding services to an existing business, it's all got to go through you know government government meetings and approvals and all this stuff. It can be lucrative, but man, I think we kind of learned. I learned some lessons there for sure. Like I want to. I don't mind commercial, but I think I'm going to stick with residential. Honestly, it's just uh, I don't know. Maybe it's just a familiarity thing. I just don't. Maybe I also don't have time to learn. I don't have enough time on my hands to learn a whole new strategy or a whole new vertical is what it
Yeah,
is.
yeah, yeah.
So
So, but with all that, I think I think we'll wrap it up for today.
I
So
think so. Yes, sir. All
again,
right, guys.
shameless plug. If you need land trust documents, and we'll work on, as Mr. Kaufman mentioned, right? There's deeds.com that can help you with that. But we'll we might be convinced to put another package out there, like a seller financing document package for the people, if need be, and you can go from there.
Yes, sir. Yeah. Well, that's not just a. By the way, none of our documents are literally just we just don't hand you the documents and throw you to the wolves. These are actual courses. We walk through every single one of these
Oh
things.
yeah, yeah. How to complete
So
them step by
yeah.
step.
Yep. Yep. Okie doke. Well, I guess I'm going to end this, and guys, we'll see you next week at it's 11 a.m. right? 11 a.m.
11
Central.
a.m. Central. You bet.
Okie doke. Take care, guys. We'll see you.